We have sister plants that we purchase components, which are located in France, Thailand, Japan, and China, to name a few. They would like to understand about planning and forecasting for those foreign exchange rates and that effect. And I think John this maybe hits on some of the hedging in, the forward contracts. And then once you kind of maybe hit on that, I do have a follow-up on the forward contracts question.
Sure. So forecasting is obviously an inexact science. They change quarter by quarter and can be fairly inaccurate unless you're dealing with the Hong Kong dollar, which is pegged to the US dollar. So it hardly ever moves. So yeah, forecasting as it pertains to utilizing economic forecasts are probably not the way to go when you're talking about forecasting future payables or intercompany movements of funds. What we try to tell customers to utilize is to utilize their banking partners and getting an approximate forward rate of to mirror where their potential payables or receivables are. That way you can get a better idea of, okay, I'm going to lock in on my margins. I just want to know what the forward points are going to be for each period. My intercompany movements of funds, can you give me that level for each quarter? So I think that's a better way of utilizing forecasts, is to at least getting an idea of what you're locking in on the margin side so that you can get what the hedge would cost for each period. And I think that's a better indicator of where you can forecast internally versus utilizing market forecasts from 20 different banks or 20 different providers, because at least you're locking in on your margins and utilizing current rates to mirror what your future cash flows are, as opposed to forecasts that could be, everywhere.
Right.
When you're dealing intercompany, like this particular question suggests, with the cash flows from different sister companies, a lot of banks sell what are called netting platforms, so intercompany netting. So if you have cash flows that go from sister company to sister company, where you have 10 companies selling to each other, all affiliated with the same headquarters or institution, a netting program could be the way to go. And what that enables you to do is essentially exchange currencies in the base or the quarter standpoint, where you can lock in on exposures by each company and netting it to its base currency. So whatever the notional currency is for the headquarters is what you can manage towards. So inquire about that. If you have several sister companies that have intermediary cash or intercompany cash flows, a netting program might be the way to go for you, and it could be a good practice as a corporate entity.
So one of the things you brought up about forward contracts, and a question that kind of popped into my head. So from the exporter side of this, do my customers like this? Is this something that's a common thing for them to see? Is this something that maybe I can only push through with some of my best customers? Or kind of walk through what you've seen as far as that goes, because obviously I see the advantages of it. But if my customer is not a big fan of it, do a lot of foreign customers expect that? Is that something that they see often?
Well, if it's a company or a customer that resides in a country that's affected by the strength of the US dollar, it's obviously more expensive for them to convert to US dollars when they're dealing in their base currency. So you're relying on them. If you're exporting and you're pricing them in US dollars, you're relying on them to hedge on their end and convert their currency to US dollars and take the risk and exposure on their end. So those countries that are experiencing the brunt of the US dollar strength, such as the Canadian dollar, Mexican peso, the euro, those types of countries, they should be more open to looking at having you invoice them in their local currency so that they're able to quantify the cost of their buying from you. And it enables you as an exporter to be more competitive, like I mentioned earlier, because you're competing against potential national companies that are domiciled in the U.S. that are willing to invoice in foreign currency, or you're dealing against in-country competitors like a Canadian manufacturer that sells the exact same type of product that can price it at a more competitive price because they're dealing in local currency terms. So yeah, those countries that are being hurt by the dollar, on the conversion side should be willing to do it, and it's becoming more prevalent, especially from Mexico and Canada.
So speaking of the strength of the dollar, I know this is something that I personally get confused often, and I have to think about it for a second. When you say the U.S. dollar is strong, is it that it's buying more of that foreign currency? So $1 of U.S. currency equals more Canadian currency, or does one U.S. dollar equal less Canadian currency when you say that the dollar is strong?
When the dollar is strong, it takes more of the foreign currency to convert to U.S. dollars, so it becomes more expensive for the buyer.
Right. Okay. No, absolutely. I just wanted to make sure. It's a very common thing that we hear a lot. You hear people on the news or anywhere talk about, well, the dollar's strong. Well, a lot of people I don't think, equate what the dollar is strong. What does that actually mean?